If there was one way to know how much you would get in return, including the risk factor when it comes to your investments, it would be perfect. One such way is CAPM. I'm Neha Vashisht from ET Markets. Let's begin. CAPM stands for Capital Asset Pricing Model. It helps in understanding the expected return an investor should get for taking a certain level of risk. CAPM considers an asset's sensitivity to overall market fluctuations and the risk-free rate of return. In simple terms, CAPM helps us evaluate whether the potential return justifies the risk we take while investing in a particular asset. CAPM does not guarantee returns, but it is a logical model that indicates how much you should expect in return for the risk you're taking. Imagine a bank offering you a fixed deposit with a safe return of 6% annually. This is a risk-free return since bank FDs are considered safe. Now, a mutual fund offers an average return of 6% per year as well. However, this mutual fund carries a medium level of risk. Would you invest in this fund and take on more risk for the same return? Probably not. But what if the mutual fund offered an average return of 12% annually? Now, things look more attractive because you would get 6% more return than a risk-free investment by taking on a little more risk. This additional 6% return is called the risk premium. It represents the extra return you receive for taking an additional risk. The formula for CAPM is expected return is equal to risk-free rate plus beta. There are a lot of websites that provide the values online, so you don't need to calculate the same, and you can use online CAPM calculators to make it easier for you. Now, how does CAPM helps an investor? It considers systematic risk as well as unsystematic risk. So what should you keep in mind when it comes to CAPM? Frequently changing variables. Since beta keeps on changing, the calculation of CAPM also keeps changing. Even though CAPM has been widely used in the financial industry for many years, some critics have claimed that it is unreliable. Like any other model, CAPM has limitations that can affect the accuracy. For instance, it relies on historical data which may not capture the complexities of the market accurately. Well, that is all for today. Stay tuned to ET Markets for more.